Tom Lee, like Doug was just telling us not to. My next guest says stocks have risen in June for the right reasons, softer than expected inflation, and he is seeing more positive signs ahead, and he's sticking with the big names in AI. Tom Lee is here. He's Fundstrat Global Advisors co-founder, managing partner, and head of research, and he's a CNBC contributor. It's great to see you. Yeah. I want to start in a little bit different way than normal because Doug just made a really interesting point about millennials and how they're so conservative in their positions. And whether you've experienced this phenomenon firsthand or not, what do you say to those who need to be coaxed into a market that is ever at record highs after a run in stocks like NVIDIA, like we've rarely before seen? I mean, is the water still safe?
You know, I know investors generally aren't comfortable buying things at a high, but if we're mid-cycle, which we probably are, then we're going to be making a lot of new highs over the next 5 years anyways. And I think there's a lot of statistical support showing buying at new highs actually has a better win ratio than attempting to buy at lows.
Well, it's also true that for all of our lifetimes, the stock market has generally gone up. So yes, there are pullbacks. Yes, there are corrections. Yes, there are financial crises. Yes, there are pandemics. But is there any reason to believe that the fundamental nature of the beast has changed for the worse? I mean, I read this research sometimes, I'm sure you've seen it, that says, oh, we're going to have permanently lower stock returns now. 4% a year is the most you should expect and things like that. We've pulled forward gains. I mean, do you believe there's credence in any of that?
I've heard that exact statement about the new era of low returns since 2008.
Right.
And stocks have compounded at pretty much the historical average since 2008. I think as long as there's skeptics out there, that means there's a lot of fuel for upside.
So is NVIDIA the thing that you look at and go, well, this could spoil the party, i.e. it becomes too much of a good thing. It really starts to lift into some kind of bubble, draws people into the market, really extends valuations, then we have to clean up the mess.
You know, there's a lot of people trying to top tick NVIDIA, you know, saying that they don't want to own it because it's expensive, but it's a 30 PE stock that sells something that no one else actually produces in the world.
The one thing it's not is expensive.
Yeah. So I'd say I'd feel very differently if if we were discounting NVIDIA being larger than global GDP and at 100 PE, and everyone's saying there's no way it can be stopped. But because everyone wants to sell NVIDIA and try to call a top, I actually think there's still a lot of upside.
When I hear anecdotes, like I heard at a fundraising thing the other night about how all the local kids own NVIDIA, what should I think when I hear that kind of information?
Well, you know, makes sense. I mean, NVIDIA is the largest stock, so I mean, everyone should own it. It's almost like if someone said, I'm selling because everyone owns the S&P. I mean, everyone should own some S&P. It's really a bearish sign when someone says the S&P won't ever go down. And I only hear people saying the S&P's topping right now.
I do remember people saying stocks never go down a couple of years ago. Then we finally had a correction. I think we've had a couple maybe since then. What kind of paradigm are we in now? We hear people saying, like Mark Zandi did, well, you know, the Fed needs to cut because otherwise the economy could take a turn for the worse. We know rates are probably higher than they need to be. Do you need to have a view on Fed rate cuts in order to support stocks continuing to move higher?
I mean, to an extent, I think that the big lesson for the last 2 years is the S&P has endured some pretty severe rate hikes. So we know companies are managing this cycle well. If the Fed turns neutral or dovish, that's even more positive for stocks. So I think that the environment for equities still is good because they survived a stress test. It's only bad if the Fed has to raise rates.
What makes you think we might be mid-cycle and not later stages?
Well, there's a lot of things. First of all, leverage is still quite low. If you look at debt service ratio, I mean, it's not associated with business cycle peaks. It's actually more early cycle. If you look at the ISMs, they've just turned positive. That's generally an early cycle sign. I think the only thing that's late cycle in people's minds is that we made an all-time high, but S&Ps are going to make all-time highs mid-cycle, and they're going to make it all the way through late cycle.
Did AI bail us out? Because sort of thinking back to this dispersion that we've seen, okay, so the biggest names have all the earnings growth, the biggest names have a lot of the market growth, and everything else is a little bit more lackluster. And you just think, okay, if you rewind the clock 18 months ago, if we hadn't had the arrival of ChatGPT and we were still working through post-pandemic gluts, I mean, you know what's been going on with the manufacturing sector. It's been a recession for 2.5 years. So did we get bailed out by AI? Is that what's extending the cycle?
I think people are doing some fake math. Also, 45% of the S&P has more than 10% earnings growth right now, which is the highest ratio in 3 years.
Wow.
1 in 6 stocks is up more than 20% this year. 1 in 4 stocks is up more than 15%. I think people are distorting the fact that there's negative earnings coming from energy, basic materials, and healthcare. That's how you get that negative 7% growth outside the top 10. But healthcare's flipping in Q2 positive, energy's flipping positive in Q2, and materials. So the number of companies with double-digit earnings growth is going to really soar, actually.
So final question, to sort of ask the what would make you bearish question, I mean, does the trend have to break significantly for you to say, okay, fine, maybe if something like a mid-cycle correction is here, or does the economic data have to change, or some exogenous shock?
Well, I think that 3 signs of a peak are when incremental return on capital is 0. So when we are at a peak CapEx cycle, I don't think we're anywhere close. I think when we are extended on leverage, so whether it's debt service ratio or margin debt's still 20% below where it was in October 2021. And I think when sentiment turns, what you mentioned, and when people say that this market's unstoppable and won't ever go down, then I think we'll have a big drawdown.
But we are not there yet.
Yeah.
Tom, great to see you. Thanks for your time. We appreciate it. Tom Lee, Tyler.
AI companies